IBA Sunil Mehta also in conversation with us at TT. Now, Mr. Mehta, good evening. This is Ruchi Bhatia. Quickly, if I can come to you, this is a request on one-time loans restructuring that you made with the RBI. I want to understand from you, with respect to the riders that the RBI has put, how important and effective will these riders be to ensure that, we don't have a kind of situation that we had many years ago of suddenly, a lot of banks misusing the loan restructuring provisions, and thereafter we saw a huge rise in NPA. So what is going to be significantly different this time around?
Ruchi, I must appreciate that regulator as well as the banking system have learned their lessons in a harder way. So they have understood the requirements of doing restructuring as well as the problems of doing rampant restructuring. So this time, it's a very welcome move that the RBI has designed a scheme which has got a checks and balances from both the sides. It incentivizes the banks to restructure a loan and give the relief to a required person who really get impacted by the COVID-19. And it also puts some boundaries. So those boundaries are basically like outer limits of 2 years for extension of the repayment period. Then there was a S4A, the restructuring mechanism. So there was a concept of overseeing committee. Now that has been replaced by a expert committee which will define about the various covenants that may be incorporated in the restructuring, and the ratios like liquidity ratios, solvency ratios, what should be the proper there for that restructuring. Then RBI has put down the exit and the entry qualifications in such a way that its misuse will be definitely prevented, and well as it will facilitate the providing relief to the genuine people who get impacted through this COVID crisis. So I think it's a very balanced scheme, and this will be much more beneficial than the previous restructuring scheme, because RBI has provided these windows in phases. First, they have provided some moratorium for 90 days, which extended to another 90 days. Now they know that moratorium may not work. So then they provided the ability and tool to the bankers for reassess the working capital requirements as per the need of the customer, then reducing the margins wherever necessary, then creation of a FITL for 6 months so that whatsoever interest obligations are there during the period of this moratorium, that can be paid through that FITL and can be covered up in the next 6 months after the operations start. So all these enablers have already been provided into working capital mechanism. And for term loans, they have come out with a restructuring.
Right.
So yes, so
absolutely.
They have come out with a very balanced.
Mr. Mehta, you're saying that this scheme is very right. Mr. Mehta, allow me to come in on that. You're saying that this scheme is very different from the scheme that we had in the past. I want to understand from you from where we stand so far. The RBI has also said that there is a possibility that if things were to go bad, then the NPA, the gross NPAs in the banking system may rise to as much as 14% from the existing 8% levels. Many say that with one-time loan recast coming in, there is a possibility that we're just pushing the can down the road. Do you agree with that view?
No, I do not agree with this view, and even this assessment may be quite conservative side that so much escalation in NPAs will take place. Let me give you 3 perspectives. Before COVID, I think if you see the NPAs of the entire banking system were declining on a sequentially on quarter-on-quarter basis. The gross NPA levels is in the range of 11%, has come down in the range of 9.8% during the last 1.5 year and 2 years sequentially. Then the net NPA levels have also come down in most of the banking sector. The capital adequacy ratios were improving till this COVID crisis was erupted. Now, this particular window is not available to all, because this is available only to those units which really get impacted with this COVID. So the eligibility window they have already fixed up. All those accounts which are having overdues not more than 30 days as on 1st March will only be eligible. It means before COVID, the account was not having any major stress. The overdues were not even to the extent of 30 days. So only those healthy units will be eligible for restructuring. We were performing, and it will not be available to the previous stress. So that way, entry-level barrier has been created. So only so that is one aspect of it. And then secondly, by putting 3 riders like So they have checked in balances. Like one of the riders that they have already produced, bankers will have to make a 10% provisions on it. So 10% provision means the banker will find that even if the account falls into NPA, they have to make only 15%. So even by restructuring, they have to provide for 10%.
All right.
So there is no major incentive for going for restructuring.
Absolutely. And my last question to you, Mr. Mehta, I want to understand from you now, ACE banker KV Kamath headed panel will be looking into and will be making recommendations with respect to what kind of norms are needed, any benchmarks that are needed for, sector specific benchmarks for a resolution plan. I want to understand from you, at this point of time, we want the banking system to be a little more nimble, to be able to take decisions in a faster way, to provide faster relief. Do you believe that this committee, while the RBI has of course given it much thought, and that is why this committee has been put into place, but shouldn't we have at least allowed the bankers to take decisions so that the whole process can move ahead in a much more faster way?
Ruchi, you will appreciate that basically if there is a standardized norm, it becomes easier even for a banker to work out a restructuring plan. Otherwise, one bank will have a different prescription, another bank will have a different prescription, and it will be very difficult to take decisions in a consortium setup or even in a multiple banking setup. So if certain guiding norms are created, like liquidity ratios, then solvency ratios, and sector-specific issues, because some of the issues, the ratios may have may require greater tweaking. Some of the sectors may be comfortable with a very less tweaking. So that is a very pragmatic approach, and I think the time frame that has been created is only 30 days. That within 1 month the report will come and these sector-specific reductions. So this will basically not delay the process. This will rather fasten the process because things are standardized, and it is always faster to work on a standardized format than to work on a standalone format individually by the individual banks. So in my opinion, this will not delay. Rather, this will quicken the process of restructuring if the bankers really go for that option in case of the eligible borrowers.
All right, on that note, Mr. Mehta, always a pleasure chatting with you, and thanks for sparing your time speaking to us at ET Now. That was IBA Sunil Mehta. Remember, IBA was in conversation with the RBI for a one-time loan recast program as well.